Hey everyone, and welcome to another episode of the Wealthologist Live. Chris Hobart here, and maybe it's your first time joining us and tuning in. I want to thank you for doing so. And maybe you're a long timer, you watch this all the time. Welcome back, right, Jacob?
Yep, welcome back.
Today we're going to take some time to break down the markets. We're going to talk a little bit about your money, and really what really matters when it comes to building and protecting your wealth. And ideally, we're going to remove the jargon. Sometimes Jacob gets a little jargony.
We'll try to.
I'm going to smack him around. And ideally, specifically these days, try and remove some of the panic that might be going on as well. Now, as you can see, I'm not doing this alone. I brought a couple of powerhouses with me today. First, as you see next to me, as always, is our lead investment strategist, Jacob Woodrum. Jacob is basically our walking economic radar. He's going to be talking a lot today about what's going on in the economy, as well as some suggestions we may have out there. And in a little bit, we're going to have the director of financial planning for the firm, as well as a senior wealth advisor, Corey Sundstrom, join us. And he's really, man, he's that go-to when it comes to smart planning, be it income, be it taxes, just be it about efficiency within a portfolio. And the stuff that works in the real world and that is really applicable to the real world. Now, so today we're going to do it like as we always do. We're going to be going through our signature segments called the 3-2-1. So, Jacob, you are going to be in charge of 3 market-moving headlines and kind of what's going on. What does it mean? How does it impact people? We're going to talk about 2 portfolio strategies that make sense in today's economy. And then, again, Corey's going to come and talk about 1 tip that you can actually use today. And then we're going to wrap up with the quick-fire Q&A, where Corey's going to take your questions on everything from interest rates to what to do with extra cash right now. So a lot of good stuff. So settle in. We got a lot to cover. And maybe a couple of different surprises along the way. Yeah, I know, right? Just hold on.
We all love surprises.
I know you
Good
love
surprises.
Good surprise. So, as we wait for a couple of more folks to filter in, I always like to check in. We were talking beforehand, and kind of like last time, we're talking about the differences of our families. You got the new baby. I've got one of my babies graduating and going to college.
Yeah.
And then we're talking about summer plans. And we just got back from a great family vacation. We went to Banff, Canada. Had a great time hiking with the family and all of that. And I said, Jacob, what are you doing?
I said, not much, actually. We're kind of cruising right now, which has been kind of nice with a 9-week-old.
Yeah, a 9-week-old. Holy smokes, I tell you. Well, but, it's kind of, again, it's phases of life, right?
Yeah.
Here you are just bringing some new folks along, and I'm kind of pushing one out. It reminds me of the cameras that we have in the office. I don't know if any of you have been watching the Big Bear Valley Eagles, but phenomenal camera. It's not quite as exciting, but earlier this year, the 2 eagles had their little eggs, and then we got to watch them hatch, and then we just got to watch them fly out. And that's what I'm doing right now with my kid, watching her fly off. And
I'm still bringing the fish and the food and all the nasty stuff.
All right, you ready to kick it off, man?
I'm ready. Let's do it.
Let's start segment number 1 for the 3-2-1. So Jacob, I want to kick things off with the 3, and really those are the 3 events that our viewers should be watching right now.
Yeah.
So what are we looking at?
Yeah, so let's start with the first one. So dividend comeback, and it's really the idea of the underdog is ready to take the lead. And so we want to talk about dividends, and those dividends are those steady payouts from companies that often get overlooked during market booms. And so we've had a bit of a market boom over the last year or two. And since the start of 2023, growth stocks have really taken, a lot of the spotlight. They've went over 80% from a return perspective, while we've had, dividend stocks really in that neighborhood of only about a 20% gain. So the differential has been pretty extreme.
Yeah, and I think the important thing to think about with this is usually you think of like the dividend stocks being the big blue chippers that are out there, and they're making enough money. They're not necessarily internally reinvesting, but they're paying you kind of like rent on your stock, right? They're paying that out. Whereas the growth companies are internalizing that money so they can grow and grow and grow. And obviously that internalization has been pretty healthy. But what you're saying is, the world's a-changing.
The world's a-changing. And I think the twist is that the dividend stocks, they're now looking like the undervalued gems of the market. And so I think we've got a slide that we can pull up here too. And right now, dividend payers, they're trading at a significant discount to the S&P. And that's what this chart is showing us. The S&P, if you look at the chart, early 2000s, the dividend yield factor versus the S&P, the discount, there was a discount compared to the S&P. Then we saw 2008 hit kind of into 2012, 2014, and we saw a premium for those dividend payers. Now we're back to where we're starting to see some value. So just to put it in perspective, the S&P 500, it's priced at what we call 21 times price, or 21 times earnings. So that just means if the S&P's earning $1, then you're going to be paying $21 for that $1 of earnings. But if you look at dividend stocks, you can pay $12 for that $1 of earnings. So they're just from a value perspective, they're just a better priced essentially for the earnings that we're paying.
Jacob, I feel like you are my wife telling me why she just bought something and trying to justify it. I mean, is it really that good of a deal?
It is.
Renee comes home and she's like, "Oh, it was on sale. Like, last week it was here, but now it's here."
Well, I was going to say, and that's where we see those dividend payers.
Purses don't pay dividends, or clothing don't pay dividends, right? So
yeah, they're on sale.
Stocks pay dividends.
Yep, they're on sale. So I think the other thing that's important to mention, and I'll wrap this point up here in just a second, is historically too, when interest rates drop, and we're expecting at least probably one rate cut this year from the Fed, dividend stocks do tend to shine. So I'm sorry to my grandma in Princeton, West Virginia, but these aren't your grandma's boring stocks. These are high quality companies, growing payouts that could drive more of our portfolio's returns moving forward.
Oh, perfect.
Yeah.
I guess what you're saying is we're talking about companies with strong fundamentals, discounted prices, and who doesn't like something like that? Specifically the potential for income generation within that's really something that you want to pay attention to. All right, what's next?
Yep. So secondly, I want to talk about tariffs, turbulence, and what I'm going to call a third quarter turn. So 2025, as we know, it's been a volatile year for stocks. We've had a decent run over the last couple months, but we don't want to get too comfortable just yet, because I think we're likely to head into some choppy third quarter actions. We could see markets pulling back or even potentially going sideways, but I think we're then going to see towards the end of the year a later climb. Now, why is that? Well, it's all about the tariffs. It's all about the crisis in the Middle East again. But I think what's interesting is history does give us, I think, a little bit more comfort here too, because the first year of a presidential term, if we look at the historical averages, the market's gained just over 9%, and that's since post-game World War II. So, I think the backdrop does remain constructive, especially if we can keep the economy out of recession. So, we've got another really interesting chart here, and this chart is really just showing us the S&P 500 and how it's reacted to geopolitical events. Now, you can see we're going back to 1960, but after initial reactions to these events, the market usually rallies. And so the median initial response is a 3% decline. Then the market recovers. 1 month later, it's a 4.7% higher. 3 months later, it's a little over 6.1% higher. 6 months later, 9.2%. And when 1 year later, it's almost 17% higher on average.
And when I hear or think of something like that, it's always, when you're in the middle of something, boy, it is so hard to look at that and say, we hear all the time, no, this time it's different.
Right.
This time it feels different, it looks different, it smells different. But that's what I love about this chart is, yes, each time we're in that, it is different.
Yeah.
But at the same point in time, it rhymes.
Right.
It sounds very familiar to what we've seen before.
Yeah, it's very true. And I think just being able to pull the lens back, and it's easy for us to do it because this is what we do every day. But I think for clients, it's being able to kind of say, okay, let's pull the lens back, look at the long-term picture and be able to kind of weed out the noise.
Yeah. And I think that's our job, right? Is volatility exists, and we see it in history. But having the right perspective and also understanding how it fits into your plan is the important part. And again, doesn't mean that everybody has to be on that same roller coaster as well.
Right. That's very true.
All right. What's your final theme?
Yep. Final theme: recession that won't commit. So, despite a shaky start to the year, we've had recession odds peaking near 60%, and that was back in March. Things have really cooled, and so today, there's only about a 27% chance of a recession. That's good news. Still something to watch, but certainly far from a certainty.
Jacob, man, I feel like you're a weatherman right now. One, you're giving these 27% chance of recession and 60%. I I
Trying to
feel
come to the table with some numbers today.
I know, but I feel like this is a really tough one to peg down.
Yeah.
Obviously everyone wants to say, hey, Jacob, when is the recession coming? And that's impossible.
Right.
But it is kind of funny because it's such a moving target.
It is.
When's the Fed going to raise interest rates? Well, I think, it's like predicting snow in the Carolinas.
Snow in the Carolinas doesn't happen too much. So
yeah, it's pretty easy to predict.
Yeah.
But they love to predict it.
They do. Well, let's talk a little bit about growth because, growth, GDP, gross domestic product, those expectations have been pulled back. And so, we're now at about 1.5% yearly projection versus 2.5% when we, did our state of the markets update and what we talked about. But, it still points to moderate growth. Inflation's moving in the right direction, and the job market, it is cooling, but it's still solid. So, instead of bracing for impact, we're really watching for balance. And I think expecting the market to kind of reward resilience, but also cash flow at the same time.
Yeah. And the thing with recession is at some point you will be right. There was this economist, Harry Dent, that consistently would preach about the next economic downturn, and it was like these massive crashes. Yeah. And the reality was he finally, like in 2008, it happened, and he was like, "I was right."
Yeah.
It's
a little bit like the international stocks this year. International's been good. Mm-hmm. But it's been a long time since it's been good, and there are certain folks that like to tout that international is this is going to be the year of international. Well, it's finally here, but anyways.
I think that's a great read on what's really shaping the second half of the year.
Yeah.
We got that rebound for dividend stocks. There's volatility, but we've got that historical tailwind, and the odds of recession dropping, but still there. I think that's all useful when we talk about our next section, the two, which is talking about how do we position this within portfolios and what does that look like. So what are the two portfolios that we're working with here that might be kind of unique or right for this economy?
Yeah. So I wanted to highlight the first one, and the first one is our income shield strategy. So I would say it's not too sexy or exciting, but it has a purpose in a portfolio or in an overall portfolio. And so it's a 100% fixed income strategy, so bond strategy. It does not have stock market exposure, so it is a traditional bond market portfolio, but it's currently generating over a 5% yield, which is not bad. It's higher than what you're getting in a money market. And I think one of the key advantages with the portfolio, one, it's very conservative, but also, if interest rates do start to come down, which we are expecting this year, this strategy is positioned to benefit. So it's kind of that classic seesaw example, if the inverse relationship of interest rates fall, prices of the bonds go up. And so it can work in our favor. And, I just think it's one of those environments that for someone who's not wanting a lot of volatility, they don't want a lot of risk, this can be a nice substitute to cash.
Yeah, I think this is the case where it's somebody that is okay not participating in the market. Right. And they want to see some level of growth, but it's not about growth with massive amounts of risk to try and get the most out of it. That represents, maybe not your entire portfolio, but maybe a piece of your portfolio. Right. Or for a lot of our clients, it's just a matter of saying, how do I still grow my money without having to take the risk of the market? A massive 20% downturn that exists hidden in the market someplace.
Right. No, I agree. The second strategy that I want to talk through, it's quite a bit different than the fixed income, but it's what we call a strategic income overlay. And so switching gears, but this strategy is unique and it's really designed for folks with concentrated stock positions.
Now, what does that mean?
Yeah. So, you bought Apple stock, Microsoft stock 10, 15, 20 years ago. It's appreciated well in value, but you have a lot of money in just one single position or a handful of positions. That's really the idea of a concentrated stock position. So, rather than selling that stock, that position outright, you can overlay and we can help with a customized income strategy that we use on top of that. And so it's kind of like, creating extra dividends on the shares that we already own. It gives us more control over how the concentrated position works. And it's nice because we can control it without having to, immediately sell it or liquidate it. And An example I think is like a covered call strategy. So it allows you to generate income by selling options on our existing position. And so it can be a more thoughtful way to get a little bit more out of a stock if we're committed to keeping it. I was kind of thinking about how to explain it a little bit better. I think it's a little bit like renting out, a stock that we already own. So I say rent out a stock, and you agree to sell at a certain price in the future, and in return we get paid an upfront fee, kind of like earning rent on the investment. So it's a way, again, just to generate extra income, holding on to our stock as long as we're okay with the possibility of having to sell it.
Sometimes, and correct me if I'm wrong, but I almost think of it like you own a car,
right?
Maybe you own a classic car and you own it. You don't want to sell it necessarily, but you want to rent it out.
Yeah.
You still want to own it, but there's always the chance that if the right number came,
there's a price, right?
You'd be willing to sell it. So it's
right.
kind of like that way of looking at it. That's kind of the idea behind that.
Yeah.
The only other thing that I'd mention about this too is sometimes people that have concentrated stock positions, it's about not wanting to sell because of tax consequences.
Right.
If it's in a non-retirement account.
Right.
And I think one of my favorite strategies to tie in with a highly concentrated position or somebody just not wanting to create taxes is the use of what's called a pledged asset line. And that means the ability to borrow against a stock, pay interest on that. It's not a margin, but it's kind of like it kind of has that same feel. But you can do that to bridge a house purchase, to do any sort of purchase without having to liquidate and incur a taxable event. I really like
Gives
that
you more
idea
flexibility
because maybe people don't want income off the portfolio. It's not a big deal, but they need to access some money and they don't want to create taxes. That, quite frankly, is how the very high net worth, they don't care about taxes because it's a matter of great. Increase taxes. All I'm going to do is borrow against the money. And then when I pass away, we're going to get a stepped up cost basis. So again, when we start getting creative with our taxes, along with some of these strategies, it can get pretty exciting. Well, I appreciate that.
Yes.
That's some good information. If anybody does have direct questions for Jacob, you can always reach out to him directly, jacob@hobartwealth.com. He's always up for a good stock conversation or economic conversation.
Always.
And we can go from there. All right. I want to go ahead and bring Mr. Corey Sundstrom up for our next segment, which is the one part of our 3-2-1. And this is where Corey is going to share a single financial insight with us. And you've got a good one today, but I mentioned earlier a surprise. It's not your birthday.
It's not my birthday, as far as I can tell.
Yeah. But recently, you gave the office a bit of a surprise. Care to talk about this?
Yeah, my wife and I found out that we're pregnant, so we're having a little baby girl that is due New Year's Eve. So it'll be quite the party at the end of the year.
Yeah, and in looking at you, I didn't even realize it.
I know. I'm not showing you.
I know.
It's amazing.
You look great. But Lizzie's doing well?
She's doing as good as she can in that first trimester. So
all right. Yeah. And I feel bad because, your parents just moved away from the area. I feel bad for your parents, and I feel bad for you as well.
Yeah, maybe they'll come back.
I have a feeling.
Yeah.
I have a feeling if I know your mom, she's going to want to come back. But congratulations to you and Lizzie, and that's exciting. I know so many clients out there and folks watching are saying it's going to be fun to watch this because we've known you now. You're in your 40s.
Yep.
We've known you as Corey, the guy that has no kids and has the ability to just go and do. Welcome, welcome, right, Jacob?
We're gonna still try to do what we do, but I'm sure there will be a wrench thrown in there here.
So you don't even know. Okay, all right. So let's go ahead. What's the topic you want to cover today? Yeah. The financial planning topic that's top of mind.
Yeah. So lately, I'm sure a lot of people have read in the headlines. There's been a lot of talk around Social Security. And so, although this has been a conversation that's been happening for years, the thing that has come up recently, more so than it has in the past, is the trust fund. So if we think about it, Social Security is partially funded by payroll taxes. And then there is a trust account behind the scenes that helps cover the extra that has to be paid out. And so we've all heard at this point that 2034 is the year. They may have even reduced it now to 2033. That the Social Security fund will run dry. And then panic ensues when people read that headline and they say, hey, what does that mean for my retirement? What's going to happen? And so I want to talk about why this is happening, what policies maybe we put in place to protect against it, but I also want to talk a little bit about how we can handle that in our financial plan. So As far as how we've gotten here, just understand Social Security was put in place at a time where life expectancies were, I think, 67.
I think initially it was 63. So, I mean,
yeah. So we're in a different world today.
Hey, you get at 65, likely to die at 63.
Yeah.
That is, I mean, the government.
Good deal for the government.
The government figured that one out pretty. That's the ultimate Ponzi scheme right there.
I know. But that Ponzi scheme got reversed.
Yes, it did.
And so now, it's not uncommon for us to see clients or their parents in their 90s and beyond. And so now you've got this situation where more people are in retirement than are working and contributing to the system. And part of that is because people are living longer. So you've got people that are taking Social Security longer than they did before. You've got, on top of that, you've got an issue where with the payouts that are going out, I'll use an example, federal employees. At the end of last year, there was, I think the Biden administration passed a rule for federal employees where they didn't get Social Security before if they were receiving a pension, and now that has been undone. So that now it's great for federal employees that are receiving a pension. They now get Social Security on top of that. But it's stuff like that eats into the system. And so what does that mean for us actually in 2033 or 2034 when the system runs dry? Well, realistically, right now, the way the numbers work, the people that are working fund about 80% of the benefits. So the payroll taxes are funding 80% of Social Security. So if the government did nothing between now and 2033 or 2034, the likely scenario is that benefits are reduced. Mm-hmm. It's not that they go away, but there's likely a 17 to a 20% reduction in Social Security benefits if nothing is done.
Now, well, and I guess that's the question, mm-hmm. which is, one, what can be done is obviously they can just increase the payroll deduction against working stiffs like us.
Sure.
So how old will I be? I'm not even going to be. Shoot. I was hoping the math was going to work in my favor, but it won't. I'm going to still have to pay into it. But what are some other facts here?
Yeah, I mean, there's a couple of things that they could do. So one, they could increase the percentage of tax that people that are currently working pay into Social mm-hmm. Security. So right now, that percentage is about 6.2% of the paychecks that are coming in. So that percentage could be increased. They could increase the income level. So right now, I think it's up to about $170,000 or so of income you will pay into Social Security, and above and beyond that, you don't. They could increase that. They could repeal the WEP provisions that Biden just did before he rolled out to help get in some extra flexibility. And they could increase the Social Security age, which we think already that our full Social Security age will likely be closer to 70 and beyond. But it's likely that there are policies put into place to help buffer some of what's happening. So it's not anything that we expect to be solved today. If we all know our lovely government, things take time and a lot of things get done last minute in Washington. But it's just something to keep an eye on. And we just want you to know, with all the news and headlines coming through, the issue is not that nobody is going to receive Social Security payments, but there is a risk that they're reduced slightly in the future.
Which that's a risk that can be scary for a lot of folks. The good news is, within what the planning that you're doing and Andrew's doing and Nick's doing, we have the ability to model that, and we have the ability to make sure that portfolios are built to structure and support and make sure that we're not running out of money, right. Or we're not putting ourselves into a tough situation.
Sure.
The other side of that is some people, we might run some projections, and it's a matter of saying, hey, it may make sense to either spend less or have a part-time job or not quite retire quite as soon. Mm-hmm. So still a lot of balls in the air, though. I mean, that's got to be a lot of definition.
Yeah.
But I know you and Andrew and Nick are hearing this from a lot of clients because you're hearing it more and more. It's been talked about for quite a while, but as we're getting closer to that date, I do think people are a bit more nervous about it.
Sure.
All right. That's a good way to bring it home, Corey.
Yeah.
So you got the full 3-2-1 experience today, everyone. We got some economic clarity from Jacob. You got some good strategies from Jacob, and that one concept from Corey to help strengthen your plan, or at least better understand where we are. Now we get the fun part, which is the quick fire Q&A. Now, quickfire Q&A, as many of you may recall, this is where I'm going to toss some rapid questions to Corey from our viewers, and he's going to give us just quick, straight answers. So
I'm ready.
Yeah, 2 sentences max. Anything longer than that, I'm going to step on your foot. All right, Corey, first question that we have. Should retirees consider real estate or REITs right now?
Yes, I think if we're going to focus on real estate, it needs to be logistics or infrastructure related. Those are still providing good, strong income in the real estate space.
All right. Now, how do you feel about international exposure in 2025? Jacob talked about this a little bit, but carry on a little bit more.
I think the key is to be selective. And so you want to look at Europe's lagging economy compared with emerging markets like India, Brazil, those types of markets, there can still be some opportunities.
Yeah, it's kind of some interesting stuff there. All right. With rates maybe falling, which I feel like we've talked about this and then they don't fall, but with rates potentially falling, what's the thought on CDs? Still a good idea?
They're still paying decent income. So 4.2, 4.3% on 6-month to 12-month CDs. Again, they're not going to be the ultimate growth vehicles, but they can be a good safety measure for a short period of time.
All right. And right now with volatility, is it a good time to rebalance, or is it just set it and forget it, close our eyes? What are we thinking right now?
Mid-year is always a great time to rebalance. So you want to trim the winners. You want to bolster the things that we're underweight on, like Jacob was talking about earlier, and just make sure we align for risk.
Yeah, and I think the nice thing is majority of our portfolios, we're automatically doing that within the strategy,
right,
which I think is the key and part of our value that we bring. All right, best hedge right now. Are we thinking it's gold? Is it cash? Or is it tips?
I think we have to look at our time horizon. And so tips are great for short-term hedging. Gold is a great diversifier away from the market if you want it. And then cash is a good diversifier against market risk if you want flexibility and access.
Okay. Yeah. And a lot of clients they might be layering all three depending. The only thing that I always look at with gold is when we look at the long-term historical play with gold, it's not great. It really is like a defensive type strategy. The issue is gold doesn't pay any dividends for the return that it gives you. So it's one of those things where I get why people like it, but it's also not always a great, a truly great investment. Yeah, exactly. All right. Well, that was, you nailed it. That was fast. It was clear. It's to the point. That's what we do here, Corey. And once again, congratulations on the baby. That's are you willing to announce gender yet, or are you holding back?
It's a little baby girl.
Right.
So if you have any girl advice, which I'm sure you do, it'll be welcome.
Run. No, I've got plenty of girl advice. So I'll give that to you as your child ages and progresses each stage.
Yep.
All right, folks. That is a wrap for this week's this month's Wealthologist Live. Again, thanks to Jacob, thanks to Corey. They gave us some great insight today. And of course, thanks to all of you for spending some time with us. We covered a lot, but I do want to hear from you. What about this did you like? What do you want more of? Do you have a specific topic that you want us to cover? Or maybe you've got a question that you want us to throw at Corey, Andrew, or Nick at the next quickfire Q&A. All you got to do is send us a message at heyhobart@hobartwealth.com. We read every message, and we build these sessions around what we hear that you care about and what you share with us. Now, next month, we're going to be diving into some big questions. Probably going to be talking a little bit about the Fed rate cut, what that might mean for investors, and also going to be talking a little bit about a quiet rotation in tech. And we've got a guest lined up to talk some different planning as well. So stay tuned for that because it's going to be pretty exciting next month. Mark your calendars for July 30th. And hey, if you want, invite a friend to join us. Until then, keep asking the good questions, stay proactive, and we're going to see you next time on The Wealthologist.